Hi, everybody. This is Phillip Guan, CPA. Welcome to the classes number 9. Okay, so we are getting close to Christmas. So I'm going to finish all the training before Christmas, live before Christmas. So the total of 13 classes is going to include individual as well as partnership, S corporation, C corporation. You pretty much learn everything. So today is the classes talking about something you're not very familiar with. Okay, I'm going to share screen. Number 9. What is number 9 all about? Okay, the number 9, Victoria, would you be able to read the
In
sheet?
this scenario, you will practice entering the following: farm income, auto expenses, estimate tax payments.
Okay, now, this is something we are not very familiar with it. Okay, but they are very similar, like self-employment, self-employed Schedule C. Similar, not to say. Okay, Schedule C, this is Schedule F. F like friend. Okay, now let's
Could
get,
you tell us about what is farm income?
I am going to,
Like example.
okay.
Caesar and Cobb Salad has been married for several years. Caesar is a daily farmer and Cobb is a salesperson. The taxpayer are both U.S. citizens and cannot be qualifying child or dependent on anyone else's federal tax return. Both provide a copy of their driver's license. Caesar's driver's license was issued in OK on January 1st, 2017, and the number is 123456789. His license expires on January 1st, 2025. Cobb's license number is 987654321 and was issued in OK on January 1st, 2017. Her license expired on January 1st, 2025. There had no interest in or authority over or any foreign accounts and did not use virtual currency.
Thank you very much, Victoria. So what we are going to do is a married couple, like what we had before. Okay, they also have health insurance, but the 1099A is not provided. So now, here's the information. I am going to split the screen. So the way to do split the screen is you move this tab on the far right, and then there's a plus sign on the right side or the plus side, not lie on the right, plus side. You click it and hold it to the left, and when they show the half pages, let go. I learned that this one not long ago, like about 2 years or 3 years ago. All this time, I wish somebody taught me ahead of time. It's very convenient. Now, this is the taxpayer social or tax ID. Open. Let me see if we have. Yeah, they have it in the last year. So I'm update. So I'm going to save a lot of typing. As you can see, this is not the real client. It's an example. I did a training last year. So this social is correct. Okay, the birthday, the name, and the social of the spouse is correct. You right click, remove, right click, remove, and they I change it to San Fran, so I change it back to okay. So all you need to do is change the zip 73001 73001. Okay, 73001. This is the ID. Yeah, those are all make up numbers. Is it possible some married couple they live in a different state? Yes. And then they have to file 2 different state tax return. Sometimes because of the job needed. No, no. In here, they don't have any tax in the year before. Those are my company's informations. So we are finished. Tab number 1. There are no dependent in this example. So as you can see in here, 2, 3, 4, 5 doesn't have anything in last year. It also doesn't have anything in this year as well. There's an estimate tax. We learned estimate tax last time. This is not the first time we learn. This will be a review. This is estimate tax. No, please mute it. Okay. Yeah, somebody is not muted. Please help me to mute them. Thank you. Appreciate it. So now they're paying estimate tax 6,000 each quarter. So in here, like 16. Instead of California, there's a special rule for estimate tax for the first 3 quarters. They can all pay due as long as November 16, 2023. They are all considered on time. For most of the California state, the taxpayer, not all. The IRS lists what county you are. As long as your primary resident address or the business address in that address, in that zip code, in the county. The last one is not due yet. It's January 15. It's in about a month. Let's say assuming they pay all. And then we also, if there's any extra, we're going to apply for next year. We do that. We round it up to the 1,000. Okay. So go back to the simple thing first. They have W2 income. Okay, let's see. Victoria was asking about depreciation. We have an opportunity to learn depreciation. Do you see all the assets? Okay, they are similar. Schedule C, F, or Schedule E. In terms of depreciation, they are all similar. Okay, let's go back to the simple thing first. Take care of the simple thing first. W2. Who's the employee? Is it the taxpayer or spouse? You can see from here. It is the spouse. So S, like S stands for spouse, T stands for taxpayer. In this situation, you can see from the top, this is the spouse. EIN number, things. I change it to the zip code. Okay, 93001. See if this is still saved there. No. 93001. Now in here, because I changed to San Fran address, so if I want to change it back, here's an easy way to do it. Look, watch this. Change it to taxpayer and click somewhere. It's already get to it. So then go back to S. That's the easiest way. You don't have to type. Now, box 1, box 2. Move this one to a little bit. So in this cases, 1, 3, 5 bucks are the same. And they did not say anything in here. I think. Did I change it to? Did I change it in here? I probably did not. Oh, no wonder I did not change it in here. Let's change it here. I forget to change it here. Or I typed it long. It was 7-3, it's not 9-3. Sorry. Okay. So and then go back to here. Do the same thing to make it. I change it to right. But it doesn't change because the first tab we put it right. So now this is good. So what was going on here? I got to go. Okay, otherwise it won't consistent. Good. What else we need to have? Simple thing first. We take out this one. We take out this one. I think so. All we learn is we haven't input doing anything yet. This auto expensive you connecting with form business. Estimate tax we take care of it. W2 we just put it in. So I think now we are going to. Oh, excuse me. The JTax software does have the example, but they're short. Look, I'm not gonna show it to you. So this is one. There. And how come here say 1 and then here that say 9 there? Oh, I think they're still developing. There may be, but nevertheless, the short version. So it's good to learn from me in the long version. Once you learn everything, and then you can read the short version. Now, did we have a chance to read this one yet, Victoria? I forget. Did we? This one. Victoria, can you hear me?
Sorry, I forgot I mute. Caesar is a diary farmer. Caesar uses cash method of accounting and he materially participate in the business. The EIN for the business is 00-5561934. There were no payments made, which require Form 1099 to be filed.
Okay. Sorry. The last one, the business code is 112120. Okay, sorry, Victoria. Okay, now I am. Let's do this. Right now, I go to do the same thing. Now, Arias, we do this one first. Also on like today's date. Also, this is a code for our company. So now we finish the whole thing in tab 1. We go to tab 2, income file in the up on the top. So we're very familiar with the left side, the first one, self-employed. That's Schedule C. That's not what we're talking today. We go back. This is what we're talking F. F like friend. Okay, now we write down now who work on the form. Right, for example, in the form you can raise all different. You can forms do a lot of different things, so they are in the same category. Okay, so now this is the code that what this one talk about. Now, what this is all about it? Well, IRS actually tells you what kind of the farming they are a special code, and sometimes they will have a different kind of a treatment. But also, IRS using this code they have a national average of each and every item from from 1 all the way to whatever line number. If you way over the way average, that is flag for you to be get audit. Because the similar kind of the business, they should be in the bill shape area. Bill shape means like the shape in the area in the middle should be about 80% average individual, and then in two sides, if you say 10%, 10%. So, but you are way over the bill shape, that's where you're gonna get audit. So when we do the tax return, we are not audit, but we also, when you see something, it doesn't make sense, we will ask the client to double check their bookkeeping. You say, according to my experience, this one doesn't make sense, or kind of like percentage, is it? Could you double check, make sure the book is right? And sometimes they do make mistake. We all humans, right? So up here, C is a cash basis. If not cash basis, we check this. Well, it's either accrue or cash. Cash basis, if you correct the money, like for example, you do the business like today is 12/14. Even you perform the service or the business, but if you have not been received the payment from your customer or clients, it doesn't consider as a revenue until you receive it. So the cutoff date is 12/31/2023. From that day, if you receive the payment, that's the income counted for 2023. Otherwise, if you receive it in January, they will count it 2024. Same as, very similar, the expense is the same thing. If you order supplies and you haven't cut the check to pay the bill yet, the cutoff date is December 31st. If December 31st you have not been paid, that expense is not deductible. All the things must be paid on or before December 31st of 2023. Can I pay by credit card? Yes. Pay by credit card consider as paid, tax deductible. Can I pay by loan money? Let's say you get the business loan and pay for it first, and then you over time pay for the business loan. Yes, you're okay to do so. You consider it's a fully paid. Now, going back to here. The first part that I'm going to highlight it is an income. They are in 3 different categories. So I'm going to pull this one out a little bit for you. Okay. Guess where are we going to put the first one? Right here. Return. Do you know in what line number? Now, they're a little bit confused. When you see for the line number, there's a big number 37 something in the far left, and then there's a small number in the second row. You're looking for the second row number. Okay, now in here. So now in here, you see
Sale of livestock.
Yeah. So what line number?
Livestock.
What line number we should put?
1B,
No,
1A.
I just
Put down
highlighted like
100.
here. Yeah.
I know, because I thought it is a tricky question, so I'm trying to give
Yeah.
you another answer.
It doesn't work all the time. Okay. Okay. So, and then how about this? How about this? What line number is?
1B.
1B.
Okay, then 3A.
No, I'm not free. I'm tricking you this time. I highlighted long thing. Yes, I think it this way, right? The sale of the product raise it. They raise it by themselves. Is it? They either
Yeah.
for them to raise it, or they bought it from somewhere and then raise it and then sold it, right? So
Okay.
this what they raise it. I think it's 2B, or 2, whatever it is.
2.
Right?
46.2.
Yeah, 1, 2, 5. It's confused. Trust me on
Okay.
that. So cost
No,
of
it's not that confused. I thought it would be confusing, so I try to
okay.
give you,
Okay,
different answer.
okay.
But now
Cost
looks
of the
like
item
Drix.
bought it for itself. What is
Yeah,
it?
looks like Drix doesn't want to trick us.
Yeah, it doesn't. It's clear. So where is it? Item bought. Is it right here, isn't it?
Yes.
Hey, let's go back to make life easier. Let's view it to see whether or not we do it right. Let's view it. View schedule F. I do not do the schedule F often as well. I do have it, but I don't have a lot. So in here, F. That's what looks like this. That's the EIN number. So now we should check the note in here later. Now, this. So they use those small number, part 1. That's what we are, because we are using cash math. So part 3, let me see, where's part 3? We don't, it doesn't belong to us. Okay, yes, because we are using cash basis in here. If you are accrue basis, use part 2 and part 3. Do you see it in the parenthesis right here? Above this, you see it. So we're looking for the small number. So we're good. Let's do side by side. Right? We're good. This is good too. And so these two minus together, they bought at 2,900. They sold at 5,900. That's what they mean. They make a profit of 3,000. The rest of the thing is they raise them by themselves. And then the rest of, so we are good in here. And then let's go back to the, we have more expenses to input. Okay. Those are the expenses. Let's talk about one thing at a time. Where is it? So those are income. Let's see, part 1 income. The expenses also on the right side. So pretty straightforward. On this side, all incomes, all different kind of income, if you have it. And this, for this client, that's it. Okay. In the reality, the difference of those two are incomes. Okay. In Schedule C, this is the cost of goods sold, basically. Okay. Now, the expenses is on this side, right here. Well, it's under the letter of A to E. It's chemical C, right there. 1900. Let's do minus a little bit. And then we get this one, move a little bit to here. I do not know how to make this one smaller. Let me see if I could. It's supposed to, I can adjust in here, but it doesn't let me in this, on this screen. But nevertheless, I think we can do it like this. Should be good enough. So now, the second one, F, like here. Like here. You can highlight it, 16. So before I hit tab, I turn my head to look the left side to see it's correct. Yeah, that I pretty much double check already one time as I input, and then I go back to double check one more time, the 2 times checking. So F, right? Yeah. 1, 1, 1. And then F. Now we go to here. G. F. Where is it? Farm business insurance is insurance. Okay. You don't put a health insurance in here, but you do. You don't put the health insurance here, you put all other insurance related to the farming. Repair, all and larger. C. Storage. Supplies. Utility. And set. Do you believe it? I actually know how to farm. I do all the things. When I was a teenager, young teenager, before 13 years old, I was born and raised in a farm, a small village in China. So I know how to do all the farm work.
What do you farm?
All kind of things. Anything you eat. Yes. Now we finished this part. Okay. I'm going to have Victoria to read this portion. Is it big enough? How do I enlarge it? Is it big enough?
No, enlarge it, please.
How about this? Enlarge it. Okay. Oh,
Caesar has been deducting business mile on his 2023 truck. The truck was placed in service on January 1st, 2023. In 2023, he drove 12,000 business miles, which are logged weekly in writing. He did not use the truck for any commuting or personal miles, even though it was available during off-duty hours. He has other vehicle available for personal use.
So in this situation, they choose to only use a mileage. In this situation, in fact, it's not necessarily a tax saving strategy, but let's do it first, and then I can tell you otherwise. Because the normal truck, it at least costs about 30, probably somewhere about 30K. And they could deduct it. And the first year, a lot more than this. Now, what we need to do, we are going to do mileage. Oh, sorry. Mileage. Mileage. Do you see line number 10? Auto. And there is a blue auto. Double click in there. Trump. They use 12,000 mileage. They don't do it the phone in the, they just use a mileage. Guess what? So, but you can do this now. It is to use the gasoline for the usage is this. Now, this expenses for the auto, like gasoline, insurance, and a tire, you're not supposed to be put it in Schedule F. The same thing as Schedule C. If you use mileage, you should not put those gasoline, insurance, and tire, the auto expenses, the actual expenses, into Schedule C. But in here, the system is going to figure out what is the highest that they're going to take the highest. Excuse me, I think I made a mistake. No, 1,500. Insurance is 8. Like this. Okay. Let me see if there's more information in here. No, that's it for the auto. Now, I do not use forced mileage. I just let the system choose which one is better. Okay. Now, if we just choose this, the mileage is they're going to get it is an auto this less than 8K. Now, this is one way to do it. But the other way to do it is they choose depreciation for the truck. Let's say if the truck is more than 60K. So now, if this situation, if they bought a new car, new truck for the business, let's say they cost them 30K. Guess what you can do? More than 6K, $6,000. So in this situation, so let's look at the depreciation first. The truck, in this situation, they can get 24K as the first year deduction. And then the 6K, they could get over 5 years, and they get a special of 2,100. So that together is like 26,000. Now, if you do use depreciation, you are not going to be able to use a mileage, but you are going to okay to use the actual expenses. So what you're going to do is you're going to force expenses. Now, if you force the actual expenses, we're not going to use mileage. And plus the depreciation. that will be more tax saving for his first year. Now in this case, this one will be less because this only comply with all this actual costs, not the mileage. But you see a depreciation in life 14. You add together, it's almost 30K, 29K something, right? It's true. Versus originally way less than 8K. So there's 21,000 more in deduction. Okay, next thing first. So now at this situation, we're done with everything except the depreciation. We have more asset to do. They are asset 1. They have been bought it in 2014 in 20K and fully depreciated. Now, Victoria was asking what's section 179. Section 179 allow you for some business asset take 100% deduction for that first year. In this situation, back in 2014, they are cost 20K, they take 20,000 100% in the year of 2014. So number 2, we can paste down. This is a new asset, 2023. It's 5,000. Seven years. So the number is it? This is internal revenue code section 1245. They define what kind of asset are 1245, what kind of 1250. But this belong to 1245 and 1250. If you really want to know what's in it, IRS have a list. Section 1245 and section 1250. You can Google. It's 7 years. Yeah. So here you use this. This one allow you in the early year get more depreciation. So number 3. Number 3 is also the current years. Using 5 years. And 1 year. Depreciation, we don't have any. The example from the last year. Now, this is a brand new asset in these places, this example. So they should not be have anything prior. Asset number 4. We go to here, base down twice. 4. Also current year. They are using $20 years. You probably wonder, well, how come, what kind of return here? So this one requires you to study, there's classes to just talk about depreciation. So, and then you need to spend some time to look at it, all kinds of, but do not worry. When you learn to do taxes, when you're hands-on to do more and more depreciation, you say, someday you can say, aha, I got it. They are pretty similar. So do you see it? This one is 1250 property. The longer, yeah, it's in the section 1250, basically. Okay, now number 5. If you're confused, it's normal, especially when you just learn depreciation. It takes some time to get into your plan for depreciations. Don't worry. You can always have somebody to talk to. So these are all assets. They also take section 179 in 18. Take all of them like here. Hey, if you already take section 179 in here, so you're not going to be put the prior depreciation in here, otherwise you will double count it. This is also part of prior depreciation. If in here, you don't need to double check, otherwise double input in here. A normal other prior depreciation is put in up there. Number 6. Mm. 8, 7 years. They also section 179. They take it. So a lot of people say, why already finished it? I still have to put it. Yeah. When you show this asset or show the business, all the cumulative depreciation literally capture as an ordinary income. So that's why you need to keep it there. So this one. This is 7 year. Okay, continue in here. It takes section 179 as well. So that's all. Now this is depreciation. Let me enlarge it. The depreciation is in here. 1 to 7 is an example. Number 8 is what I add on. So in here, the first one is already, those are prior year depreciation. They taken all already. But more importantly, in this example, we are taking the current year special depreciation, bonus depreciation. On top of it, we're also taking a regular depreciation. So as a result, we take a quite bit of depreciation and the total amount 44K. As you can see, from all the way 128K minus all expenses, include depreciation expenses, and get cheap like this. So let me tell you, let's say in the example, let me see if they provide you an answer in here. can always click log in. Now, we are number number 9. Here's the answer. Now, we are going to have some different than the example. Let me show you. The example, there's 67K from net income, so 130. Ends up have this one as about a little bit more than 10K extra. We ends up about 16K extra. But what is the difference? Here's the difference. The revenue portion is the same. All other expenses, they are the same. It's the depreciation makes difference. They use mileage, and we did not use mileage. We use the actual costs plus the depreciation of the car. And you also take the bonus depreciation, but they did not take the bonus depreciations. So in here, by doing this way, if you're using the way we are doing it, for this client, in this year, you save about 6K in federal taxes. Okay, so if you're using the mileage and you also do not take the bonus depreciation, you are actually paying more in taxes. And that's it. So with that, I finished today's training. So any more questions for me?
So for the section 179, the first year is 100%, and thereafter they would have a limitation, right? A maximum limit.
Well, if you take 100%, the second year you have nothing to a depreciation.
Okay,
So you
but
the second year,
100% rule is for the first year, right?
you can take 100%. The maximum you take 100%, and then but also there's some limitation for something. So for example, you buy a computer, you can take 100%. Okay. Now for car, there's a limitation. As you can see, the car in here, you buy in 30K. Do you see it? They only gave you 24K. The 6K you have to be over 5 years to depreciate it. Like here. They don't let you take the whole 30. Take the whole 30K in here to do it. So the law changing in depreciation a little bit year after years. In the year 2022, actually the law allow you to take the full 30K. In 2023, do you see it? Each and every year they they gave you you have to laugh a little bit. See, look, this is 13K. This is a 15K. They only allow you to 12K. So, okay, the software is always take consideration of the new update law, what it is, so that they can give it to you. Now, of course, at this moment, the software is still under development, and sometimes because they first release of the software, and sometimes they may be fine-tuned a little bit. But as of right now, the training, what we got it, the way I see it is the first year bonus depreciation, it does not allow to take 100% at this moment. Where in year 2022, you can take 100%. Okay, good questions. It's not going to be have a fully answer for you to be fully, okay, I fully understand it. When I study accounting and learning depreciation, it take me a while to get everything into my plan. Don't worry. Once it's like you know a person as a person first time, and then sooner or later you become a friend. It takes some time to become a friend of you. Okay. So with that, I'm going to finish today's training. So thank you very much and have a great day. Okay.